Very simply, they don't take into account the substantial impact of reduced equity on household balance sheets. That's just not part of any of your standard models in economics. Macroeconomic as well as microeconomic general equilibrium models, what they do is model the flows of economic activity. And if capital enters into those models, capital only enters as a service flow in the system. And so as a result, the effect of severe stress on people's balance sheets and the corresponding stress in the banks is not part, you see, of the way we think of those flows perhaps being modified. That's not part of the way we normally think of the appropriate way to model the economy.
Yeah, in fact, the decline in the value of U.S. equities between 2000 and the middle of 2003 was $10 trillion. And one of the first questions that Vernon and I were puzzling over in the fall of 2008 was, at the end of the third quarter in 2008, the value of U.S. homes had fallen $3 trillion. And yet the financial system was in complete disarray. So the predictions that Federal Reserve officials had made in 2005 about the impact of a decline in house prices was completely at odds with what happened. The impact on the financial system was devastating from a $3 trillion decline in house prices, whereas it had been almost imperceptible from a $10 trillion decline in equities. So there was something missing in their models. There are a variety of different macroeconomic theories, but most of them have their limitations. Very few macroeconomists saw this problem coming. So there are a lot of problems with the current theories of both these large-scale economic cycles and with how to respond to them. And we think that more work with just documentation of what takes place and with comparison of what takes place relative to different policy responses is going to be a more fruitful approach than theorizing.